Alrighty, I think we should be good to go. Hey everybody, welcome and thanks for joining us. Welcome to GuruFocus's September members engagement meeting. And we've got special guest here and Guru himself, Jeff Auxier. And he's the president and CEO of Auxier Asset Management. And he's been gracious enough to join us and share a little bit of his background, his perspectives, and some lessons. So make sure you put your questions in the chat and I'll get those over to Jeff and I'll let Jeff take it from here. So, Jeff, thank you.
Great. Thanks, Will. Appreciate it. You guys have a great service. I've used it from the beginning, and Charlie's been great. And thanks so much for having me. Just a little background. Yeah, our firm, we've got a small boutique firm, just about $1 billion in assets. And we have the Auxier Focus Fund, which we founded in 1999, right at the top of the market in July. My background prior to that, I was real fortunate. When I was 10, had a lawn business with a 16-year-old, and we had mowed lawns in a lot of the nicer neighborhoods in Portland, Oregon. And I was exposed to a lot of the founding families of Georgia Pacific, and was real blessed to meet Bob Pamplin, who from 1958 to 1976, he took $100 in Georgia Pacific to roughly, I think, 3,300. So I was exposed early on and to investing, and that kind of got me excited. Back in '82, I actually called Warren Buffett on a Saturday, and he took the call. He took several calls, believe it or not, just out of the blue. He was real generous, recommended books, the Conservative Investors Sleep Well, and obviously Ben Graham's book. And then he mentioned a number of investors, like Lou Simpson, and who I then kind of flew around the country and met a lot of these great investors, back then, Shelby Davis and John Templeton, and a lot of great value investors. So that was real fun. And my whole goal was just to study great operators, study great investors, and Don Yackman, he was a great influence. And so that was my passion, was really just to become a great business analyst. I attended 27, or I have attended 27 of the Berkshire meetings. And that, as you all know, is a great background. So again, the focus has been from the very beginning, actually what Buffett said. I was asked him if I should go to Columbia, and he said, no, you should actually get a farm and get far away from Wall Street and start from A and go to Z, and in terms of the studying companies. So I pretty much have done that since the beginning, and we do all original research, and the cumulative knowledge. I like the saying, wealth is not money, but it's cumulative knowledge. And like George Giller said, it's that cumulative knowledge and the application of knowledge. And studying Charlie Munger and Buffett, and over the years, just that voracious research appetite. So it really has paid off, just in terms of spending time on the operating realities of individual businesses. Right now, there's more ETFs and mutual funds than there are individual stocks. So we just think there's huge opportunities. Our fund, when I started, my frustration was opening up all my statements on my retirement plan, not knowing what was in there. So I committed 100% of my retirement to our fund in '99, right at the top of the market. And little did I know that from '99 through 2009, that was the worst 10-year period in U.S. market history. So, but again, so I pretty much can't pull money out of that fund as long as I'm the manager. But that was again, half the funds I think out there have zero invested. And right now, I just think the opportunity with everything pooled up, people don't really know. And you talk about cumulative knowledge, and one thing I'm learning about studying Buffett is, compound knowledge, and compound investment returns. Those two things are critical. So my focus is on really, 6 to 8 hours a day of research, and just really not missing a day. I always look at, guys like Michael Phelps who went 5 to 6 years, 7 days a week swimming, not missing a day. I kind of think capital allocation is like that. It's not making trades necessarily, but covering the facts and fundamentals and the operating reality. So over time, we've just got to know like who are the great players in terms of great operators. Or way back it was Sam Walton and Saul Price and Jim Senegal on the retail side, and then over time we've just tried to find exceptional managements. We found now it's so important to have um, that great tenacious management. And just look at you can see Jensen Wong what he's done. The irony we've missed this move, but he went to high school maybe 20 minutes from our office, and then he went to college at Oregon State, before he went on to Stanford. But that's just that's just the great thing about we're looking for I think it was at Mario Gabelli coin, the PhDs, poor, hungry, driven. And so that's what's great about investing is you can really, if you work hard to find, um, you know, these great companies and these driven managements. And so what like I say, when we're building portfolios, we're just trying to make great buys and to get the double, triple play. We're looking for the margin of safety, but we want to buy it right. And you look at over the years, like I say, if you look at everyone pooled up today, they're not really getting any cumulative. They're not building on the knowledge of like who are the great players individually, and that's kind of what we've done over the years. And our bigger holdings, over right now we've got Microsoft. But again, basis is maybe 25 in that. But Sandra, the CEO, has been exceptional. And again, we're trying, again, we're looking at that as I get older, we're putting greater weight. Things like Philip Morris, which now is ironically, nicotine is kind of being touted as, a treatment for Parkinson's. And Philip Morris has kind of gone to this new, the smokeless side, which so that ICOS and those businesses are really taking off. We actually have clients that are up 100-fold in that stock, but so these are kind of businesses in our top, like Mastercard, Visa, Alphabet, Kroger, United Health. These are really strong businesses that over time have have really um, had a strong moat, but equally important, the management team on the capital allocation side is really important. We like founder-led companies, ideally, or family. We've been with the Amos family and Aflac, Dole. We like insurance. We like not only the float, but the investment ballast, the investment portfolio. And so over the years, those have been a good place. We like the digital side, like things like Booking or Alphabet or Meta, where you're kind of digitizing advertising, travel, and companies like Walmart who are utilizing that technology. But actually, and we've done a lot in foreign. Our biggest winner in the fund has been First Service. And they do property maintenance. And I met the uh, the current CEO, Scott Peterson, and I was looking at this company. It's obviously extremely dull, right? Property maintenance, but I think it's up 9,500% since we bought it back in '05. But we like repair replacement. We like things like Lowe's, Home Depot. Parker Hannifin has 4,000 replacement parts in aerospace. So we lean on those kind. We have a company called Gates, and they do hydraulic hoses, because you tend to. I've lived on a farm since 1988, so you tend to go through a lot of hydraulic hoses. So we try to look at the practical application of, repair and replacement versus you look in China, top 50 developers are basically all bankrupt, right? So when you're in the construction side of things, we don't like that. We going back, you see these huge build outs right now of AI, and we just remember back in '99 the Peter Kiewit, was kind of leading this charge into fiber optic, and we just ended up Global Crossing was big, and then it went out of business, and we ended up using maybe 15% of that capacity. And then you just look at these big CapEx spends over, the marijuana. We met the top leaders in that, the top 10 leaders, but we never did anything because there wasn't, they way overbuilt. There was never any profits. Prior to that, we had the shale build out in 2000, 12, 13, I think it was. So we tend to buy, businesses that have lower tickets, higher inventory turns. You look at like um, the inventory turns, like a Kroger, they might turn inventory 16, 17 times. You look at Visa, MasterCard, small ticket. Um, those are just more enduring. When I first got in the business, I went back 30 years to see, what were the best winners. And they were just basically, in everyday items. And we even today, I go back 100 years, and people don't realize, a dollar invested in the tobacco industry, which is the number one industry, over 100 years grew to like over, I think it was over 6.2 million. But I was like, when I first got a bit, I couldn't believe that. And there's a good example. Everyone worried about tariffs. Well, they've had excise taxes basically going up in that industry forever, So you got to look at the underlying business. That's kind of an oxymoron. You think, how could that possibly be? But that's why I always say, investing is a craft of the specific. You need to dig in to these companies. A lot of these ideas you just think, wow, that is so contrary to what's obvious. But that's why we've liked to go more into businesses that are not magnets for capital, because that in time, that excitement, euphoria, too much capital. You look at what happened with AT&T and Verizon. I mean, they just overbid. They overpaid for spectrum, overborrowed. Not only those two, but the entire global telecom space did that. So we see these waves of excitement and investing. You go back to 1920s and all the innovation in RCA. They were the most widely held stock in the 1920s, and it hit 102, I think, and then it dropped, I think, down to 2 or 3 by 1932, 33. So, we've seen the innovation, and then we've seen, and the other thing is people don't realize the markets will go, they tend to go in really good 16, 17 years. Then you'll have real flat years, like Buffett talks about 1964, the Dow was 1,000. And by 1982, when I started, it was 888. So from 1964 to 1982, 1,000 to 888. So these are things, and again, Buffett talks about you have long stretches where the markets don't go anywhere. But if you're not doing individual research on individual businesses, those periods like from 64 to 82, you had to be you had to make individual selections. I mean, because obviously the indexes, and then back, I remember in Japan in '89, and everybody was just so high in Japan, and the Nikkei dropped from what 39,000 to 7,500 over the next 25 years or 20 years, and even up until like a year ago, I think China really hasn't gone anywhere for over 25 years. So again, we get back to investing is a craft of the specific. You need to master the game. And it's funny in our society, everybody's wants a pot full of money, but it just doesn't. Money without knowledge just is nothing because you can lose it so fast. So we try to mitigate the risk through just intensive 7 day a week research effort, and we found that's the only way to mitigate risk. Every decade I've been doing this. Now I'm doing more research than ever, mostly because I like it. But without the research, we would be dead, you know. So, um, but it's a lot of fun. I get a kind of a kick out of how much media attention is put on, you know, the Fed and Fed governors, and these guys are like rock stars. And I'm going like, you know, there are some great, you know, founders, CEOs. Um, like you know Lane Bouchard, you know, alimentation, you know that's had like a 25% CAGR since 2000. And you look at some of the you know founders of like Monster Beverage, that founder just or that CEO just retired, and that stock was up 72,000% over 20 years, number one performing stock from 2000 to 2020. And yet you never hear about, you know, you hear more about, you know, the Fed chief or whatever. I mean, you guys like Wendell Weeks of Corning, and these guys have just been monsters in terms of, like I mentioned, you know, Scott Peterson. I mean, you know, First Service, I mean, 10,000% roughly for a property maintenance company. So those to me are the real heroes of, we had a company, uh, uh, Scott, um, who runs Lincoln, Lincoln Educational, and so we met with him. Stock was two, and they train electricians and welders amongst other skilled labor. And I just looked at them, super high integrity, and you know, everyone hated the group. And so I met with them at two, and then 5 years later met with them at, you know, it's at 20. And they're that those are the ones, you know, everyone wants to be concentrated in the nifty, you know, the top Mag 7 or whatever. But we always caution, if you go back to the Nifty 50, you know, and those 50 names, you know, the same one decision stocks. And, you know, as inflation picked up, you know, those stocks dropped, you know, 70, 80% back in the early 70s. So, um, you study where, you know, everybody wants to get rich quick and they don't want to do the homework on more. So what we try to do, like in our fund, is we have a lot of names, but a lot of those are just we'll follow a name for 5 or 10 years before, often before we buy, you know, and we really want to know it. But like again, in today's world with program trading 80 to 85%, you know, no one really knows what they own. They just, you know, and they're following. You know, all the charts and the technicals. But you know, we want to be in businesses that, you know, that over time. And we have originally some clients, we were fortunate to get into Costco right before it went public. And yeah, I think that stock's gone from 17 cents to, you know, over 940 or wherever it is today. But you know, Jim Sinegal, and he had studied under Saul Price, but you know, no one holds those, you know, no one holds that long. Um, and that's kind of the lesson. I mean, if you find these great, you know, like Jeff Bezos, these founder CEOs, and I go back to Jensen Huang, I mean, that is just an amazing story. And so we all get in, our industry is all into like, you know, looking at, you know, small cap this or whatever. I'm going, there's a heart and soul behind these businesses, you know. If you look at, there are some proven winners. Look what Doug McMillan's done with Walmart, you know, in 10 years. And, you know, Walmart is kind of wasn't doing that great. And then he has really applied the technology and you know, to and you know that um, so that's kind of like, you know, Glenn Fogel at Booking's another one. You know, you look at Booking, how well they have done, you know, digitizing the travel industry. And so that's the thing. There's a heart and soul behind these. And I mean, look at Meta, what's happened there. And so we're big on not only having a good business model that's like we talked about, repair replacement, small ticket, high inventory turns. You know, we like the insurance, like Marsh McLennan, the Aons of the world. You know, I think we have Aon all the way back for clients some back at 250, I think, and stock's well over 300. But that's kind of the moral of the story is like if you can, like Buffett says, have a 100-year outlook and spend your time becoming a better business analyst. Um, and that's what I've tried to do. And fortunately, I've had the passion from day one and I still have it, and so I think that's kind of the big thing. See, everyone kind of aspires to retire, and I go that Bob Pamplin when he retired, he was 65, and I asked him, he just retired from Georgia Pacific. And he said, I go, are you gonna what do you play golf? He goes, no. He goes, I'm gonna get started. So from 65 to 97, he built one of the biggest denim producers in the world. And so I learned a lesson. It was kind of like, wow, because that talent. You look at how much of Buffett's return has come after he's hit 65. I think I'm not for sure, but I think it's over 80 to 90% of that return on Berkshire because he's got the cumulative knowledge, which helps you, keeps you out of harm's way. But that's um, that's why I think it's so much more fun to find a heart and soul behind these businesses as opposed to just talking about, this index, that index, small cap, large cap. I mean, it's kind of like you're missing all this opportunity to make legitimate, like the Monster. I was amazed. We bought that. I mean, we didn't buy it at the beginning, but um, what Rodney has done. He started. I think it was they founded that thing in 19. He was there. He just retired, but like I say, from 1990, I think is when he started. But I mean, people miss that whole move. I mean, nothing against Coke or Pepsi, but I mean, 72,000%, and so that's but things do change and fundamentals change, and that's why you have to do the work. Like Peter Lynch says, if the earnings are going up, the stock will do well. If the earnings are going down, and all that attention needs to be focused on the operating reality of these businesses because they do change. I was looking back, Kodak, I remember in 1989, number two employer in the country. And you look at what's happening and went back, I remember 83, there were I think over 32, 34 IPOs and personal computers. And so tech is treacherous. A lot of you remember BlackBerry and those, and you just have to have the humility. I think number one is like, I remember John Templeton wrote a book, The Humble Approach, and the humility is so important because you have to have the humility to do the current homework. I mean, it's good to have cumulative knowledge, but you have to get the current fundamentals because without that, and that's just, you have to. But I always watch or read biographies like on Kobe Bryant and just these tenacious competitors. They're not in it for the money. I mean, they're in it to master the game. And that was like Henry Singleton. He was like, I read everything I could on Henry Singleton. That guy he was, I think, one of the best early on was studying way back in the 80s. The way he managed for Teledyne. And I think Warren Buffett's mentioned him and Charlie Munger as well. You know, um, but that's the thing that, Buffett says, choose your heroes carefully. And that's so true because to endure, one, you need high grade ethics. And but then you need that tenacity to just keep driving on. And it's not, like I say, it's not for a pot full of money. It's to get better service the customers better, get a better product. And you just look at some of these like just the founder like of LVMH, they are what he's done. So that it's kind of the moral of the story. Like I say, get to know businesses, what's a good business, and then get to know managements, founders, families that care more about the business than the money. And then if you've got a good one, hold on tight because the temptation is to trade around. But um, we found if you can even is the news is horrible around United Health, but 10,000 in that stock in 86 up until this year, I think it's still worth over 50 million, where, 10,000 in Ford over the same period is about 10,000. So it really pays to differentiate amongst, what's a good business, what's a bad business, what's a good management. And, that I just, big fan of reading everything about Sam Walton, just having that drive, to just keep getting better and better. And reading up just I read a lot of biographies, just like Disney and some of those that how hard they worked. And that's the big thing we look at. It's not so much, like I say, size of company, or it's more like, where are you finding? We just like the Asian work ethic. I mean, it's amazing. We study China a lot, and just what is going on. We have actually T-shirts we made for our firm at 996, not too popular, but 9 to 9, 6 days a week. But that's it's we've actually funded companies, large and small, and in the venture side as well. And every time I go to Silicon Valley, I'm just amazed at the tremendous work ethic. Back to NVIDIA, I mean, that is all earned just through sheer, you know, persistence and drive and what have you. Um, but current market conditions were, like I say, you got to look at the operating reality, because the news going back and forth can freeze you up. But we're following those earnings, and again, I think there's a huge productivity. We do have a lot of Alphabet, just because we're a big fan of YouTube. And uh, they've been, they kind of pivoted into AI back in 2013. And so we just look at the value of the value of what they provide their customers. And we do like these high free cash flow yields. Not too crazy about the big capital spending. We're the large language models to us seem like they could be um, commoditized, especially when you have seven models out of China that are um, the open AI models, and they're just, Baba is finally coming around, but some of the chips are coming up with, and what Baba's doing in terms of AI and DeepSeek. And so we see a future, the big future in the small language models. We actually have investments in that area, that where you can take that data, and actually it's more private data. It's not on the cloud. And that's where we see the huge profit potential. But the problem is, there aren't the engineers out there that can distill that down from a large language model down to inference. So that's an area where, and you're seeing what, Meta is paying for these, ridiculous. That spending is, I think it's going to come back to buy. Usually when you overpay and overborrow, you usually get clipped. But um, so, in the problem we have in general with tech is, if you look at what China, they went after EVs, they went after solar, and now they're going after chips. And at some point, I just think, as they've driven most of these prices down, that longer term, we're worried about that, just because we've seen in the past, we deregulated telecom in '98, and then, Lucent went out of business, WorldCom went out of business. In fact, we have a chart in front of me that the top holdings in '99 and what they did over the next, 25 years, and it was pretty ugly at those prices. But so we're looking at, the competitive barrier to entry. But when you see the amount of capital going into, like, say, 400 billion in these data centers, I mean, we don't see how the returns are there yet. I mean, maybe they will be, but um, usually when you spend that much money, like we talked about fiber optic or in telecom, when there's exuberance, there's usually too much money. And so we're inclined to be invested in the companies that are utilizing the technology. Although we do have Mike, obviously Microsoft and Alphabet and Meta. We do own those stocks, but these are concerns, we're looking on the risk management side um, when there's excitement and there's magnets for capital, we tend to like the dull businesses that are not magnets that tend to have high free cash flow yields and not. But we are in a boom. It's pretty much AI is taking all the oxygen. So right now it's currently like that. But we've seen that with Cisco back in the late 90s, and everyone wants back in the 1920s, RCA, everybody owned RCA. So the tendency is, I remember when Dell was red hot and people would just buy Dell on margin and what have you, and WorldCom and Enron and, and we actually got out of Enron at 80, and there was a funny story because they had bought our local utility. So we met and we looked at the balance sheet. You said, this is like an obvious sell. I go like, what am I missing? And the same week, same time period, Fortune came out and they said Enron was best practices in utilities. And anyway, then it subsequently went from 80 to zero. But um, we're pretty skeptical of conventional wisdom on when it comes to these booms, and you just don't know when. WorldCom was just sizzling hot, and advisors, I remember they were putting half their money in WorldCom, and it went to zero. But we're not predicting gloom, and we just say you have to look at the operating reality, and watch that supply. Because right now the market's actually, if you look at supply demand, I mean, again, we've cut the number of public companies in half since 1990, and we don't have the IPOs. Back in 99 we had over 400 IPOs, so that was the supply that really just drown. I mean, that is too much supply. We haven't had that yet. And on the positive side, we've got deregulation, we've got a steep yield curve, so that bodes well for things like regional banks. And on the negative, you've got 37 trillion in debt, and usually, if you have a bad balance sheet, your rates have to go up. So that to us is a big factor. In terms of, you just don't, right now, the governments have the bad balance sheets. That's why gold and Bitcoin and what have you, because governments throughout the world have been loading up on gold because, again, the balance sheets are so bad. So that in the irony is spreads on high yield bonds are the tightest they've been since I think 1998, I believe. But back in '09, I remember we bought, I think, 35 bonds. The spreads on high yield versus governments, they blew out to like over 21%. And right now, I think they're less than 1%, I think. So those are like some current fundamentals where, again, what we've had to do is buy. We try to buy when things are hopelessly out of favor, and then have a margin of safety. But most of the buys we've had recently have been in areas that the insurance pricing is kind of, it was real strong hard market. It's kind of it softened up a little bit. So, some of the great, like Progressive and Chubb, some of those have come down. And AIG's really they've really turned that business around, and it's got double digit growth with a very low multiple. So that space has been attractive. And then, just things like Deckers, or, now you really have to find some problems that are going to be fixable. So we try to buy, that are fixable, versus, you know, just businesses that are swamped with too much capital. But that's, recently things like Fiserv have been hit really hard, and that's had a really good operating history. Arch Capital, they're and again, the United Health, Elevance, CVS, they have been hammered, but again, the pricing, things do get repriced annually there. So the CEO, the current CEO now of United Health, he I think it was '06 we got into that, and from '06 to I think it was 2017. Um, but he's a really good operator, and so that's got problems, but he's a tenacious operator as far as being focused, and so that's the good news on that stock. And the bad news is they expanded in Medicare, and that aggressively, and the pricing was not the pricing got reduced by Biden at the same time. So, but we, like I say, we do tend to like insurance when it gets out of favor, because of the ballast of the investment portfolios as well. And that's kind of like, what Berkshire's done so well. They've had the inherent leverage of the portfolio, or float rather. So Buffett's been able to use leverage without debt, and that's kind of been I think secrets, one of the secret sauce to that compounded effect, basically enhancing that return there. Um, and So there's some questions we have. It says, what are some of the winners and losers over my career? And like I say, what Buffett and Munger says, the the big errors are mostly of omission, in terms of, but going back, I would say, the Philip Morris 100 to 1 on that since I started. Again, the Costco's, when Costco's at 18 cents to 9.50. Visa, MasterCard, those have been big winners. I think we're in like 20 in MasterCard. This is actually just in the fund. I'm mentioning some of those, um, but mostly the smaller names, like the First Service, we like buying smaller names and just riding with them, over several years. But, again, repair replacement, good businesses. The mistakes have been, when, things like uh, the media side, we got hit on that. We've really liked John Malone and over the years, and he's been fabulous. But most recently, this with Netflix and the disruption and streaming, we got hurt on Warner and some of those. So the losers have been usually where the technology has um, come in, and or so we try to keep on that, but still, sometimes you just, um, you can't always. But I'd say we really haven't suffered permanent capital loss. The biggest thing from '99 through 2009, that was our best period. Yeah, and that's primarily because this is really done well. Another question we have, when do we sell? Well, I priced the portfolio. I was taught this way back, to price a portfolio by hand. That was by the family I worked for. They was on the Force 400, and I had to price a portfolio by hand every day, twice a day. And I go, can I use a computer? It's like, no. So we do price everything. We are on the details. When to sell is a really good one. And again, we look at the strength in the operations. I mentioned Monster Beverage, 72,000% over 20 years. That stock was never cheap, So you just have to really look at look at Costco at 55, 60 times. That's one, we've been, lightening up when it gets, you know, and we tend to scale out even on bubbles. Years ago we had Nokia. at two, and that before it was a phone company, and then it ran to 50. Well, we sold that maybe 10 times between 40 and 50. So we tend to scale in and scale out. And so you can kind of ride the bubble, but we found you need to be aware that anytime um, the whole thing can collapse. We always talk about if you're down 50%, you got to go up 100 to break even. If you're down 90, you got to go up 1,000. Like Nvidia, I remember it went up like 17-fold, I think from 99 through 2001. I think it was up 17 times. And then it dropped 90. Well, that drawdown, is pretty tough for clients to take. So we've found that you really, we don't use options. The last options I wrote was like 1983. We sold some calls on Phillips Petroleum, 45 calls that got bought out at 92. That was the end of that. So we try to really, get to know these companies well. The fundamentals are strong and the management's great. We're willing to endure the drawdowns. If that fundamental picture is intact, in that Visa Mastercard, been extremely volatile, but the average stock fluctuates 50% a year, and we're just not into taking our gain at 20% of the thing. We're trying to make literally 10, 20, 30, 40, 100 times our money over 50 years, so that's how we're thinking. But the thing is, if you have dishonest management, or like United Health, the new CEO came in and we were looking to sell that because he never came to work, like the new CEO, you know, he's in there 7 days a week, and I'm comfortable with that. But so we did have an interesting sale that worked out. We did sell all this. We made like 11 times our money at Silicon Valley Bank, and the problem is we knew the two prior CEOs really well. I sat on boards with those CEOs, but the new generation came in and they were using these models, and we didn't like. The old generation was pricing the loans and everything by hand, and the new generation was using models, and then their models, they went long duration, as everyone knows, at the time when rates were at 5,000-year lows. So we, so in Enron, we sold that because the balance sheet was so bad, and they were selling like 40 to 50 million a quarter insider sales. And then we look at the accounting, like what worries us about tech right now is a lot of the depreciation schedules, even with the bonus depreciation, they've been extending these depreciation schedules. So, if the accounting's bad, there's a great Howard Schultz, a great PhD in accounting, he wrote a book, Financial Shenanigans, and has saved us over the years, because if the accounting's bad, then you have to sell. If the integrity of the company, and if they're not running it for the for the customer and the employees and what have you, in high grade ethics, we've learned if the ethics go from high grade to low grade, or if you get a big ego. Years ago, Willamette Industries was bought out by Weyerhaeuser, and the CEO of Weyerhaeuser, he had to get Willamette at any price, and he overpaid so bad that we had to sell Willamette or Weyerhaeuser because the overpayment was horrible. And even if you look at Kraft Heinz, what happened with Berkshire, 10 years, the returns have been really not real good there, just because, when you overpay and overborrow, those are the trends when we usually will sell. Even you look at Buffett bought Precision at 37 billion. I think they've written that down now to, I think, maybe 28 billion, but even last year, I think they only made 800 million on that 37 billion investment. So usually when we sell, it's if we see overpaying, overborrowing. Serial years ago, Washington Mutual, they made 33 acquisitions in 3 years, I think. And we had one of our clients was like the number one bank CEO in the nation during the thrift crisis. And I said, well, what do you think of this? And he said, well, we can only do one a year, 33 and 3, I think it was. So we were out of Washington Mutual, and Washington Mutual dropped from like 45 to 0. So those are the sells. When you see, again, serial acquires that just overpay, overborrow, and then the accounting is really back to Howard Schultz, Financial That's a book I'd recommend anybody read, that Financial Shenanigans. And it's so those are the sell points usually. If you've got a really good company and it's overpriced, that you will often peel back those too. We've scaled out of things. That when you get over like 30, 35 times earnings, we tend to scale out of those and bring them down. But usually the major cells are going to be, where you see, like AT&T took their debt up to like 250 billion. I mean, they were overpaying for everything, overpaying for media, overpaying for spectrum, and it's just, and that's when you'll rob 10 years of returns. But that's a good question, and when to sell. And like I say, there's no real formula, because what I've learned, like Munger said, there's really no formula in this other than just day to day, grind it out detail. And when you get away from that day to day grind it out detail, usually you get into trouble on the risk management side. So I'm looking for other, or if you guys have any other questions, feel free to shoot them over. But that sell side, and then like I say, that's why the operating fundamentals. We like the Peter Lynch approach. Is just you're on the fundamentals, you're trying to catch the turn, but you got to own them. And so we'll have literally hundreds and hundreds of tracking stocks that we own that we're watching daily. And when we see a turn in the fundamentals, then we'll take them up. Sometimes it'll take years. Years ago, we had a company um, that called Guidant, and they were a leader in heart stents. And so this CEO is named Dollins, and I'd go to the conferences and meet with him, and the uh, I said, well, um, I'll never get to own your stock. And it was 40 times earnings every time I met with them. Well, anyway, they stumbled. It got to 11. Anyway, we bought it and did real well at 11 times earnings. We bought it, I think, at 28. Boston Scientific bought them out for 85. So another question, what do we think about the current market levels? Again, the S&P, the indexes are so dominated by tech and AI right now. Outside of that, we see pretty good value on companies. But again, the fundamentals outside of AI and tech, that portion are not that they're not that compelling. I mean, there's a lot of like if you look at these tariffs, they're in Oregon, for instance, Canada's cut out all the wine, and we export a lot of that, and farmers are getting hit by inputs. So the fundamentals are pretty tough in the transportation. You look at the chemical side, Dow and Lyondell Basel. And so in the auto side, I mean, you really got to look at these businesses. So we've never really bid the indexes. That's why we always feel like as a steward, we need to explain everything in detail. I figured if we ever got sued, I could bore a jury for like weeks, because we know so much about our fund portfolio. But generally, the market, you just have to dig into the holdings. And right now, I mean, the fundamentals are really strong for the Microsofts and the Alphabets, but it's more a function of when do you sell. It's more like if those fundamentals start to deteriorate, or if they start making a little disturbed with Meta, paying 100 million for a research analyst or whatever. That seems a little extreme. So, um, but we don't. What we've learned is, look at these businesses and the fundamentals, and look at now again, if you're statistically inclined, normally it's 20 less inflation gives you the market. So we should be, if inflation's running at 3, you should be at 17 on the multiple. So if your stocks, but a lot of like the insurance companies like Arch Capital and AIG, I mean, these are like 10, 11, 12 times earnings. So there are things out there, but that is it is worrisome if inflation stays high. But generally, socialism is kind of the key to inflation. I mean, when you have free markets, it's more deflation. I mean, you look at the competition coming out of China. I mean, the inflation levels when you have free market competition, now we do have wars and that those are inflationary, but um, generally, but that's kind of the big risk is multiple compression, and that is what we're watching for. Um, so what fundamentals do we look at when we're buying a company? So usually we identify ahead of time like all the businesses we want to own. Like we go through all these companies and say, this is a really good business. I want to own this, like, and then we're watching those like a hawk. And then if there's a stumble, um, we want to be ready. And that's kind of what we're like an 87 crash. I mean, we knew exactly what we wanted to own. The markets what back then the market was like 23 times, but the rates went from 7 in January. They went 7, 8, 9, 10. So the rates were skyrocketing. We're going like, this thing's going to blow. And the market kept going higher and higher and higher. But we knew ahead of time what we always know ahead of time what we want to own. Then we're usually waiting for, you know, an algo headline that knocks it down or whatever. So right now with trading like 85%, the algos control and that they're pretty much headline based. And so we want to know those companies ahead of time, which ones we want to own, and then we have trackers on all those companies. And then when the time is right, like we've been buying alimentation, Couchard's out of Canada. They're this number two in convenience stores, with Circle K and what have you. But that stock has been it's down back to about a 10-year low, but we've watched it. They were trying to buy 7-Eleven and they've been hurt because of that uncertainty. But usually that's kind of it's more like, okay, let's take all the stocks out there. Which ones do we want to own? Which are good businesses? Which are not like airlines. Buffett talks about from the Wright brothers to 1990, the industry lost more than they ever made. So there's just some industries that are not gonna like look at the autos. I mean, we're not gonna go there because generally, I mean, with China making $11,000 EVs and what have you, and so but that's what we want to know on the entire universe. Like, what are the best ones to own, and then let's try to buy them when we have some temporary problems fixable. And then how do I use GuruFocus? Well, we use GuruFocus all the time, and we do, like to read about, everything that they're. I think the service is excellent. We do a lot of um, just looking at, their write-ups and the statistics, and we're just trying to get deeper into the balance sheets and income statements, and GuruFocus helps that way. And foreign valuations too. We have a lot of foreign stocks, and some of our big winners have been foreign. Um, like Yum China at $3, and people go, oh, China's uninvestable. So I think on the foreign side, GuruFocus is excellent, but it's harder. But we're finding really good value in a lot of the foreign markets, But GuruFocus, those are obviously much more treacherous, but we think it's a great service. I mean, like I say, when I started, my whole thing was let's find the greatest operators and greatest investors, and just after Buffett said Lou Simpson, I spent a week with Lou Simpson, or find out like everything about Jim Sinegal and Costco or Saul Price, and then like you say, and then we work back from there. Be ready when they get hit. Be ready to step up there. But those are really good questions.
Well, we're getting kind of close to the end here, so I figured I'd give you a question of my own, Jeff, and we could kind of wrap it up after that. You
Yeah.
mentioned early on that you got the importance of knowledge accumulation, some good recommendations you got. What would be some recommendations you'd leave with our Guru Focus audience here?
Oh, you mean in terms of books, you mean, or
Anything, yes, sir. People to follow, books to read, anything in that regard.
y- yeah, no, I think the big thing is the find biographies on just super high achievers, high ethics, and then just study that mentality of mastering whatever you're doing, right? And I think, like I say, I remember John Templeton always said, you've got to get your data. You got to read it. You can't listen to it. Generally, I mean, as far as now, you got YouTube double speed, right? Which is good. But you have to be grinding on fact finding. But what I found is studying, you know, great founders over time and how they always run into what seem to be insurmountable problems. But if they can keep their teams together, they'll usually win because they'll have the cumulative knowledge. But I always go back to cumulative knowledge, compound interest. Those are the big thing. Focus on compounding. And then the Buffett rule, the first two rules, first rule is don't lose your capital. Second rule, don't violate the first rule. But if you can keep protecting on the downside, through mitigating the risk through research, but without the research effort, I mean, I think that's the critical thing because everything changes, and if you're not ahead of the curve, that disrupts the compounding. And but the other thing I would tell people is don't quit, like, because you're way more valuable at 70 or 80 or 90 with that knowledge. And I think there's a huge mistake to quit when you have that kind of cumulative knowledge already.
Wonderful. Now, those are some great lessons to leave everybody with, and thank you so much for joining us and sharing your experience and perspective. This has been just super valuable. We really appreciate it.
Yeah, thanks. Well, you have a great service. I really appreciate the chance, to be on here.
Alrighty.
All
Well,
right.
thank you
Have a
everybody for
great day.
joining.
Thank
Thank you,
you.
Jeff. Alrighty. Till
Okay.
next time.